Good day, entrepreneurs. Today we're gonna cover how do we measure our performance? How do we measure the value of the business? And the only way we measure the performance and the results of the business is by looking at the financial statements. So financial statements, they're actually like your report card on how well you have done. They also highlight quite a lot of things. They highlight your credit risk. They highlight your systems that you have in place, how you are managing that in terms of risk. They also highlight your accounting notes, how you are compared to the industry norms. They also highlight how you have been managing your business in terms of stock losses instead of bad debts, maybe your credit collection, in terms of also of stock management. We will be covering those items today. But before I actually move to the board, I would like just to highlight, majority of people usually do not take financial statements seriously. Let me just articulate. It is the only measure that we use in business to value the business and also measure the performance of the business. So if you neglect it, it's almost like you're a student that goes to varsity for 3-4 years but never gets the certificate for a degree or even knowing whether they are progressing on year 1 to year 2. And that's the challenge. I think in most cases we take financial statements as just for compliance. And to a point, we get so negligent that we even sign them without actually reading them. And we have no idea what that means and what does that read for me to understand so that I can make different decisions. Remember though, the financial statement is just a summary of all the decisions you have made. And if you cannot track or see your decision making, the result of those decision making, do you think you'll ever change those decisions? I doubt. Now, I'm going to move to a board and show you the way you should be looking at financial statements, starting from performance, position, the accounting policies, but also looking to the nitty-gritties within the breakdown on asset, debt, revenue, and also expenditure. I hope you're going to learn 1 or 2 things which can help you to actually make better decisions, because at the end of the day, it's all about making decisions that count. Let's move to the board. So, as I said earlier, today we're going to be covering financial statements, your report card. The report card that you get annually. Isn't it amazing that we have a way of measuring how we're actually performing? But before we take it to that level, we need to figure out what exactly are we measuring and how do we actually start to measure on day-to-day basis so that the 365 days does not come as a surprise. To some of you, it always comes as a surprise. To some of you, you've already know inside of you that things are not going so well when it comes to your card. So I'm here to give you some tools and things that you can actually put in place to manage your performance on daily basis with the aim that, you see, if you have a best day, a best hour, and you're constantly thriving for that, you will have a best week, you will have a best month, and you will also have a best year. So all of it is about the habits. It's about what is it that you are willing to do on daily basis and what is it that you are not willing to do. I'm of a view also that most of the time when our performance is actually reducing, it's not necessarily because we cannot earn or build up a high-performing organizations. It's because there is no accountability. You are both a shareholder and a director. And 2, you are also not monitoring your own productivity as yourself. How many hours have you put in? Can you really track in those hours, was what you were doing attributable to the goals and structure that you actually have set and the activities? Or are you being pulled in by other people's emails so that you can catch up? So then you end up always being reactive in the way you're running your business. I would like you to start thinking very hard about your own planning, starting from saying, I want to achieve this much on my goals. From these goals, you will then break them down into specific milestone of the things that you intend to do. And then at the end, work backwards to see, hang on, what do I need to do daily so that I can actually achieve this goal? It's not going to happen overnight. You're going to need to watch up your habits. You're going to need to watch up your routines, because everything in the whole universe, it's a system. You need to do things in a certain way at a certain time. And if you have not figured out that part, everything that you do is going to be random. Therefore, even your performance is going to be random. Now, let's start with the financial statements. Apologies, this session is going to be a little bit long, but I want to break it down for you so that even those that do understand the basic of financial statement can also learn one or two basics that will help you to manage this better. So we're going to start with the financial performance. And I will prefer that we just work on the financial performance first. And this financial performance that we would work on will help us to break down certain things so that we're clear of what we need to watch for. Please remember, financial performance is actually income statement. Is what the accountants will also call it financial comprehensive income. And sometimes they will call it financial performance, but in most instances also they will call income and expense statement. It's the same thing. Again, don't get freaked out by words that I'm using. Focus on what's the purpose. What's the use of the income statement? The purpose and the use of the income statement is to monitor the activities, the economic activities that you actually have conducted in your business. These economic activities will be classified in two ways. One, you will have a revenue, and two, you will have expenditure. But within that framework, we need to break down that framework so that we analyze and understand how we should actually be reading and understanding the financial statements. The first part that we need to talk about, as I said, is revenue. So what is revenue? Revenue is sales, is the money that we have brought into the business. The accountants will call it revenue, some will call it turnover, some will call it sales. It doesn't matter what you call it, but it's the money that we actually have earned. Revenue, we have about five types of revenue. We have sales, which is the sales of goods. And we also have services. Services, we will also call it as fees. And we will also have dividends. We earn dividends when we have some equity, or in other instances, it's a preferential share when we have both equity and also a debt. But we earn dividends when we mainly have shares. The other revenue stream is what we call interest. We call this interest received. Interest, we earn it when we have an investment or a loan that we have given to someone and that person is paying us the interest. And in the books, it will show as interest income or interest received. We also have another line item which other people will call it other. Usually when we have an item that is called other, it will be things that are related to admin. So maybe in your business, when you are having a take-on client, you will charge a client an admin fee. That is where we will include that specific line item. You will also have interest earned either when in your terms and conditions you charge clients when they have not paid you on time, you will charge them interest. So you can have either an asset that is with someone where there's a loan agreement, or you can have interest when someone has not paid you, and within your terms and conditions you are actually have specified that that person will need to pay you for the time that the account is overdue. Those are basically the basics of how we will generally classify the revenue. What you need to understand as an entrepreneur, that the recognition criteria for this in your books depends on how the accounting processes and systems that you have in place actually work. Let me make an example. For sales of goods, you will only be able to record that once you have delivered the goods and the goods are no longer in your possession. The transfer of obligation and benefits have actually been passed to the person who's the buyer. And when it comes to service fees, is when the person who received that service say, yes, I have been rendered that service. So be very careful of dealing with transactions where you are receiving money in advance. Let me just also make an example for you. In one of the clients that I'm working with, they provide grants to entrepreneurs. This grant lasts at least about 8 to 12 months. When I came and analyzed the books, I realized that the previous accountant has just taken that money received in advance and put it in the income statement, which is now showing as though this business is generating revenues that are high, which attracts tax. I then asked the client as to what exactly is the agreement about. As you analyze, I analyzed the agreement and realized that the agreement was over a period of time. And should the entrepreneur break that agreement with the grantor, they will actually have to repay the whole amount. I then asked, why then was that income recognized immediately? Because there's a conditions that needs to be fulfilled. And I think basically what I am saying to you, be careful on your terms and conditions. Whether we are talking about the service fee, or we are talking about the sales of goods, even in other instances, the admin. When do you recognize your revenue in your books? Recognition of your revenue should only happen when you have fulfilled the obligations as per your terms and conditions. Yolelo had already covered compliance. I hope she has covered some items relating to your terms and conditions. And for me in finance, it's about when did you deliver those items and what was the agreement when you deliver those items. I guess in olden days it was easier. you will look for a delivery note. These days, we no longer have those documentation. So you're going to need to figure out how to automate your delivery note when it comes to goods delivered. But when it comes to service fee, make sure when you present your project and you get the client to actually accept and confirm that they do agree on the matters that you actually have raised. Now, when we are building up as a business, we need to understand that the sale of goods, as I had indicated, will very much be linked to us selling stock. What is a stock is what we call inventory. Inventory is the stock that we are keeping with an aim to actually sell. However, when it comes to professional fees, we generally will not necessarily have a stock, but we might actually have some consumables. Now, consumables is part of the stock, but it's the stock that we use, we're consuming in the business. Whereas inventory is the stock that is ready to sell. And in other industries, we call this finished goods. Now, as you're building up, we will build up the understanding of financial statements so that we link the sales of goods and inventory, and we also link the services, which has got a small portion of consumable. What I would like to actually highlight to you is that when you have categorized your revenues in this way, it's very easy for you to kind of see where do you get most of your money. I generally say to entrepreneurs, for you to have a clear picture on how you're doing in your business and structure your charts of accounts, you will need to have these categories in your books. Charts of accounts is what the accountants will design when they're designing your management accounts. But once you have done this, let's just say in your company profile, you're providing a set of different services. And because I understand my business better, I will actually maybe use my example. For example, I earn service fees to facilitate. I also earn service fees to coach. I also earn service fee for consulting. And therefore, in my books, I have service fees in these categories. The reason why I want to make sure I monitor this is to see how much and which one gives it most money and which one has requires most of my effort in selling and also in delivery, but also the results that effort actually gives me. So then I also have different categories when it comes to sales of goods. I sell books. One of my books is Essential Finance Handbook. And in the books, I will then again have a different category in here where I will say, I use the name of the book. So Essential Finance Handbook. Why? Because I also sell manuals to other trainers that would like to use my training material. So that is also goods. Now in here I will say manuals. I could actually break it down to components because I have 5 manuals. So I could break it to components. I have how to set your goals and achieve them, component 1. Component 2, mastering your compliance. Component 3, how to earn money. Component 4, how to keep money. And component 5, how to raise money. So I could actually break it down, but I haven't. Because in most time what we have noticed, Different service providers will choose them as they see fit, but in total, those will be 20 modules. And this, by the way, entrepreneurs, is what we call white labeling. What is white label? White labeling is when you allow someone to take a copy of something that you own and they use as their own. So when I give them in my Word document so that they can amend and based on what they see fit. By the way, you could also have another line item, which I have not done yet, but I am thinking about doing. That is what we call a license. That will belong in here on the service fee. So a license fee that I can actually have in my business is when I go and train other teachers to train my content, and they then pay the license fee for them to maintain and use my material, and every year I update the material, almost like a franchise. So there is a lot of ways you can break down your revenue. At the global view, as I said, it will be sales, interest, other, which will be basically admin and dividends. And you can also then, once you have built up your knowledge and understanding, go to your company profile. Ask yourself, in my company profile, what exactly am I offering? Can I take that I'm offering and break it further down on my books? It's almost like you're creating a sub-account within these global items that we have discussed. And you break it down, like I have said, so that you can see which one gives you more money. As I said, on mine is facilitation, coaching, consulting, and then when it comes to the service of the goods or selling of the goods, I have the book, the white labeling, and now I'm thinking and working on how do I make sure that I license what I am actually doing. And that will give me the license fees. Now, entrepreneur, once you have done this mapping on your financial performance, you now need to ask yourself, what trends does this information provide to me? How many times do people buy the book? When did they buy the book? You are now starting to map out something that looks like this, where you're monitoring maybe from January, February, and this is period. And then you are checking. You can check this in rand, or you can check this in quantity, depending on what suits you. In our business, we do both. So in here, then we start saying, hang on, in this month, March, April, we actually make more sales. Why did we have more sales on that period for Essential Finance Handbook, for example? In most instances, it would be because we use the budget, the revision of the budget by National Treasurer or the Minister of Finance to align with what we actually have just done on the update. So the demand during that time will actually just skyrocket. But here, the other months is quiet. So it's our promotion that is taking up and giving us that scope. So when you map up here, you will know that, hang on, something is up here. That is because we are using what? Promotion. Everyone is talking about the budget speech. Everyone is talking about what has changed. So entrepreneurs are also want someone who's going to provide some sort of perspective of focusing only on the most important thing. Again, when you then start reviewing, you will start seeing a certain trend. Why do we need to know the trend? We need to know the trend so that we know when to promote. We also need to know the trend so that we know what to do next year around the same time. It's almost like your past informs you of the future. And isn't that in anything in life? That your past informs your future, and you can only change the future if you are very aware on what you have done wrong previously for you to do better going forward. Now, I hope you have the first component and understanding, because for now we only have dealt with what? Revenue. Once you have worked out the trends, you then start planning. You then start asking yourself what has worked, what has not worked. And as you build up that knowledge, you document your sales processes so that you build systems. The business is built from system, not on random. And if you find trends like this, ask yourself, how can I make sure that this continues? It starts here, but you rather have it consistent than having skyrocket, because it means you may not generate as much revenue because the effort is too much. The effort is too much. Business requires consistency, doing the right thing at the right time, all the time, and constantly getting the result. That is why franchises usually quite do well, because the results are predictable. And when your business is not predictable, it's a business that you cannot invest in. So can you figure out how to take your skill, your offering, and find out how you can build on it as an asset so that you can bring multi-stream of income and different categories so that you run a sustainable business that generally generate revenues that are consistent. Please consider some of the ideas I have spoken about here. I will now cover the expenditure. I hope as you are making notes and building your understanding of financial statements, you do also break down the items that you are doing. Remember, I said use your company profile to help you to remap more detail now. Because when you are categorizing it according to those 4 or 5 things that I gave you earlier, it will only just be at a global view. Your aim is to be a manager who's very close to their numbers so that you can dump products and services that are not bringing you money. Now, as we talk about the expenditures, I need to talk about the matching principle. I call it is a law of universe, because in most instances when we do not follow it, we really struggle to get our ducks on the row. We have discussed about revenue, but in those categories of those revenues, there is a cost associated with that earning of the income. And that cost could be direct or indirect. Doesn't really matter much, because what counts is the bottom line. So the only way you can influence your bottom line is to make sure that you keep your revenue high and you keep your expenditure low. In the previous session, I had shown you financial statements. I think it was a cross like this, where I said, this is the income, which is revenue, and this is expenditure, and I said, this is asset, and I said, this is debt, and this is financial statement. Today, as I said earlier, we are only focusing on financial statement, but we're going to go more into detail of each of these components. And right now, we've just done what? This one. So we'll use this as our checklist. Expenditure. So within expenditures, we actually need to have a very clear idea of how much exactly does it cost for you to produce that service, or to produce that product, or to even to render it. Because sometimes a product development which is producing of that service does also cost money. So with an expenditure, we need to actually break down the expenditure in different categories. You can decide whether you break the expenditure by nature. Nature is what that has done, basically. Or you could actually break it down by function. By function, maybe it would be something like marketing activities, human resources. It could be corporate service expenses. So you need to choose in your business what makes sense to you. I prefer to set up my management accounts according to functions. The reason why is because I also want to monitor the cost it takes to get certain things and how long do they take to deliver me that. But in addition, how much exactly are they bringing versus how much I am putting in. So in my business, my management accounts are almost set at both views. I can be able to see my books in terms of functions, but I can also be able to see them in terms of nature. So when you're setting up these expenditures, you gotta need to be very clear whether that expenditure is a direct or indirect. An indirect expenditure is an expenditure that is basically allowing you to be able to see your cost of sales clearly. How much did it cost me to do this? An indirect expenditure is basically your operational expenses, which is generally would be rental, maybe paying for motor vehicle in other instances, and depending on the nature of your business, how you have set it up. I want to just kind of make some sort of notes for you in understanding on how you should be managing your expenditures. Remember, earlier I spoke of a matching principle. What does that mean? It means that the revenue that you're bringing to your business, when there's a related expenditure, you must be able to match it so that you know how much money came in, how much money you actually expended. You see, when you have done that revenue subcategories, you will be able to see how much did you spend to actually earn that money. That is very important because some entrepreneurs run businesses or offer services of which they do not make any profit. Now, when you are building up on the expenditures, you will start by saying, I have business administration. I had explained this previously, and I hope I'm not gonna repeat myself. Business administration is anything that we do in business that is routine, that no matter of the size of the organization, will need to actually have it. Business administration is finance, human resources, information technology, and also legal and compliance. And the last one is office administration. Any business needs those. Any business needs to have those in place, and that is what we call business administration. Number 2, we will have business development. Now, business development is about reaching out to the market, whereas business administration is very much internal focus. Whereas this is about outreaching to the market. So when you do that, what are you doing? Marketing, sales, public relations, stakeholder relations, and also the last one, customer relations, which will include customer service. The last one is what we call operations. Operations is about your service delivery, your research and development, your product delivery, your product and service development, and in other instances, you will also have project management, depending on the nature of your business. Some people on operations have included quality management systems. I personally do not feel you need to have quality management system on your operations, not unless that is how you get selected in your organization. For example, I'm in an auditing space. It's highly regulated, so quality management system will need to be definitely on my operation because I get audited for doing certain things when I'm providing a certain services. So I need to make sure that my processes and systems are up to date when I get audited. So I'm of a view though, in generally, quality management should be across all processes and systems that you have created. So once you have set up this understanding, you then ask yourself, how much does this cost me in my business? Because you'll find that the items that are sitting in here are really a direct expenses which you can't get away from. But the ones that are in here are generally will be indirect. And I'm of a view that with this, you will then see how much compliance is costing you. Because some of you think going to Pretoria and registering business, it's just a small amount. Yes, to register is a small amount, but keeping the compliance up to date, making sure that you are fulfilling the obligations as a director, as an entity, there is a cost. Legal and compliance. HR, there is a cost. Even if you are not employing a person, it's just you who's an employee. Your N19 needs to be completed every month for your own UIF, for contributing, and SARS, MP201 every month. So there is definitely quite a lot. I'm sure you did cover some of those. So all I'm saying to you, with these things that needs to be done, have a clear structure like this, so that as you're building up the content in relation to the expenditure, how much does it cost me to do these things, you are clear of how should you be categorizing them. Because at the end of the day, you're going to need to ask yourself, am I investing enough on my business development? Have I invested enough on my administration? Maybe things are falling apart because you don't even put time in. So in my business, I try by all means to put at least 5%. I've built system. When you start, you might spend more time on admin than when later then you and focus more. I am not focusing as much on this. I think I'm still working in the business instead of working on the business. I guess as a professional, that is one of the biggest things to do to replicate yourself. So, but anyway, try by all means to work in your mind on how you can make sure the expenses based on the highlight of the things that I have mentioned, you categorize, you look at this, where am I spending most of my time, how much, and how much am I spending? And constantly then ask yourself, once you have this, how does that relate to the income that you're generating? And that is how you should structure your income and your expenditure. And this is what we call financial performance. Again, check the trends. Ask yourself, why am I incurring that expenditure during that time? Guys, just remember, the reason why you cannot work out your cash flow projection is because you are not planning. Number two, you are not monitoring the trends. You will never be able to create a cash flow projection if you are not monitoring the trends and figuring out why I'm actually have a cash withdrawal during that time versus, because then everything is going to feel like you're doing everything in random. The second last two, which is now balance sheet, which is asset and debt, I will cover that in a very short space of time because this is the most important part, financial performance. Position is almost the results of the performance because assets generate what? Income. And the income that you generate is actually has been generated because you've spent certain money and effort. There's some sort of an effort there. And that effort is financed by the debt, which could be your debt, i.e. your shareholders' loan, or equity, or it could be someone else's money. The trick in business is that you should make your performance look so good so that you're attractive to use other people's money. Because only then you can really scale when you start using other people's money. Now, let's cover the financial position. So a financial position is really about the value of the business, but it's not the real value of the business because it's on a book value. It's on a historical kind of present at that specific date. So that is why when they value business, they use different methodology and they compare those methodologies. But on essence, that on that specific date, the financial position is the value of the business. So let's look at this in terms of assets. So we have assets and we will also have debt. Now, assets, we have two types of assets. We have current assets and we have property, plant, and equipment, which in other instances we call it fixed asset. The current asset has the following line items. It has inventory, I mentioned that earlier. It has cash and cash equivalent, which is your bank. It also has the accounts receivable. The accounts receivable is your customers that owe you money. Customers that owe you money, we call them accounts receivable. We are expecting to receive something from you. Now, inventory, cash and cash equivalent. Within a cash and cash equivalent, it also includes the money that is a call account, money on call, fixed deposit, as long as these items are within or less than or equal to 12 months. Whereas these items, we intend to use them greater or equal to what? 12 months. So this is a short term and this is a long term. And this is a fixed asset. This is actually assets that we call them, they are generally liquid. What do I mean when I say liquid? You can easily turn them to cash. When we spoke about financial strategies, I spoke about how you could be buying stock, and in terms of you getting a loan from bank or whoever, you can actually get this from your supplier. I also spoke briefly about you can take your debtors and sell them to a banker. But remember, you may not get the full 100%. So under current assets, you need to watch for the movement of stock. What is the movement of stock is what we call inventory turnover. How long does it take, or how long do I keep my stock? The longer you keep the stock, the more risk. Because what happens, the stock gets stolen, it also gets spoiled, it also, when it's sitting in the warehouse, you lose money because that could be the money that should be sitting in your bank, in your call account. So the movement of stock, counting stock, having some controls there. I hope you did actually watch the video on the controls because that also will help. Now, under cash and cash equivalent, I've already mentioned, this also includes the petty cash, which is the money that you have in your pocket. What you need to watch for here is that do not sit with a lot of money in your current account. Your current account does not earn you interest. So always be very clear what's your working capital, and only keep the money that you need on your working capital, and the rest of the money put it on your call account. Even if it's 30 days, that should be fine. The last one, what should you watch for when you are reading your financial statements under current asset for accounts receivable is what we call an age analysis. What is an age analysis? An age analysis is when you actually are reviewing the financial statements on your age analysis for your customers to check how long do they take to pay you. Are they actually living within their credit limit? Most entrepreneurs don't even set a credit limit. 2, are they paying as per terms and conditions? Do you need to get a lawyer to actually hand them over? What are your terms and conditions? So that is what you need to watch for when it comes to current asset. I am then now going to move to property and plant, which is the fixed asset. Under property and plant, when we're talking about financial strategies, I said you need to understand the cost implication of owning the asset. How much does it really cost to own that asset? And I would like you also to focus on the capacity of that machine to make sure that the return on investment or on that asset is actually making sense in relation to the cost. You might find that you don't necessarily have a cost yet because maybe you bought it yourself. Then put that cost as part of, if you were to loan the business that money, what should have been a cost in relation to what that asset is actually bringing. Again, things to watch for that most entrepreneurs do not actually pay attention to: the fixed asset register. Don't read the fixed asset register, you don't check it, then you're also being non-compliant with Companies Act. As a director, your roles and responsibilities to make sure that that fixed asset is at the registrar office, at the registered office of your company, but also you need to make sure that it's actually correct. Cleaning up of the fixed asset register is at the end of the year, assess, was my accounting policies that I've set, for example, the accounting policies is when we're setting up the timelines that we will be using these assets. We call that useful life. So useful life of that asset, is that realistic? You assess that useful life so that it allows you to see, because when you set it at the beginning of the use of the asset, you are estimating what has changed. Is the asset performing better or worse? Because if it is performing worse, you might actually need to reduce the life. But if it's performing better, you need to revise and extend the life of the asset. So watch out for that on the asset under the balance sheet. I am only now going to cover the debt. The debt basically is about the short term and the long term. It applies the same principle as per the current liabilities and also the debt, which is a loan. Basically, debt is covering the matching principle again, because on PPE we use bonds, for example, or long-term debt. Whereas on current asset is your suppliers. Remember I said for inventory, you're gonna use your suppliers. And I also said that as you're building up the trust and the value with the client, you will be able to actually understand what are the key areas that will help you to raise funds, which will then help you to finance. Remember, what comes first is investment, not necessarily the debt. Debt is just a supporting structure for your business. I hope you have learned to actually understand your financial statements by us highlighting these components. At the beginning, we didn't when we were doing this. But for you to build up the value, even if it's a book value of the books, is to make sure that all this is always kept high. And in everything that we have covered today, I hope you remember that the assets should always be higher than the debt. And I hope you have enjoyed the session. Please leave me with the questions and comments. I hope this makes sense. Go through the notes, go through your financial statements, bring your financial statement next time when you are having a Q&A so that I can actually tell you what are the things for you to watch for. Thank you. See you next time.